Welcome to the Cliffwater Direct Lending Index quarterly webinar for 4Q23. My name is Fran Byers. I'm the head of capital markets at Cliffwater, and I'm joined with Steve Nesbitt, CEO and CIO at Cliffwater, and the creator of the Cliffwater Direct Lending Index. Cliffwater is an alternative investment advisor. We were founded in 2004. We are active across the alternatives investment spectrum, and we currently advise on or manage over $100 billion in alternative assets. The format for today's call will entail Steve running through the biggest takeaways from our 4Q23 index results, and then I'm going to follow with some of the biggest market trends we're seeing in the direct lending market, and what we expect to see as the year progresses. And so with that, Steve, please take us away.
Thanks, Fran. So slide 2 covers performance, both short-term performance and long-term performance. Let me start with the fourth quarter and calendar 2023. If you look at this table, the bottom row shows the CDLI total return for these different periods. Again, the index is unlevered and gross of fee. Excuse me. For the quarter, the index produced a return of 2.95%, very healthy return, above average for quarterly periods, and a calendar year return of 12.13%. If we look above at the component returns, you'll see that, as with most quarters, the principal source of return is interest income. For the fourth quarter, 2.99%, almost 3%, would translate to 12% per quarter. For calendar year, 12.08%. So with reference rates at 5.5%, with private debt being floating rate, high interest income translated into really good interest income for 2023. Importantly, we look at realized losses. So these are defaults/recoveries, losses from impaired assets. And story here is for the fourth quarter, very low level of losses, only 8 basis points. That brought the calendar year losses to minus 86 basis points. With the long-term average, if you just glance to the right, losses average 1.03%. So it was a pretty good year. Not a great year in terms of losses, but it was a pretty good year of 86 basis points in losses. And importantly, the most recent quarter, it was almost nothing. Okay. Unrealized losses, as we've talked about in the past, are markups or markdowns. Talk more about that later. But basically, these markups or markdowns reflect the valuation firm's view of future losses, and or a reversal of past markdowns or markups. The story here, again, for the quarter, really nothing. For the calendar year, a unrealized gain or markups of 92 basis points. And so I'll talk later. This is really a reversal of the markdowns in 2022. So again, very good calendar year, very good quarter. If we flip to the right-hand column, look at the long-term performance of the CDLI, bottom row, right-hand corner, 9.46%. So as we've said repeatedly since we launched the index almost 10 years ago, we fully expect this to be a very high single-digit asset class over time, with intermittent ebbs and flows, with an amplitude that's really pretty small compared to other asset classes. And again, from inception, right-hand column, double-digit income, realized losses average about 1% per year, unrealized gains at minus 25 basis points, but these unrealized gains and losses should converge quickly to 0%. Turning to the next slide, I wanted to give you a visual depiction of how we think about this and how we think about changes in these inputs over time. So if you look at the bar chart, light gray bar chart, this is trailing 4-quarter income return. As I reported for the 2023, that was over 12%. But if you look over time, obviously interest income ebbs and flows with changes in short-term rates and credit spreads. But it's basically been interest income between 10 and 12%. But again, varying, but not by a whole lot. Then in the dash line, I wanted to show you that income adjusted for credit losses. So this is what we would consider kind of a real income net of losses. And if you look at that dash line, it kind of circles around the absolute level of interest income. On average, it falls below because generally this market has net losses. I will say early in pre-financial crisis, you saw some gains. It was really a different market back then, a lot of mezzanine with equity stubs that produced positive realized gains. But that's really gone now. And basically that dash line post-financial crisis really reflects realized losses that you might expect on a pro forma basis. Okay. And then finally, for those of you who might be allocators, track the capital markets, people also are very interested in income minus the credit losses, minus the T-bill rate, what they might call the risk premium. And so the risk premium over time for private debt or CDLI, as represented by the CDLI, has always been positive, okay? And it fluctuates because of varying interest income and realized gains and losses. But basically, it's always positive. The worst year was about 3% during the financial crisis. But it always, otherwise, it's generally between 6 and 10%. That is a very attractive risk premium. When people talk about equities and the risk premium in equities, they talk about 6%. So what the CDLI demonstrates here is an attractive risk premium relative to equities, and as we'll discuss a little bit later, we had a much lower risk. So here I'm showing the averages, same background, okay, interest income averaging 10.86%, that horizontal gray line, okay? If you subtract out credit losses, okay, which average a little over 1%, 9.80% average rate over this almost 20-year period. And then if you subtract out the risk-free rate measured by 3-month T-bills, you get 8.44%. So I know T-bill rates have been perhaps arbitrarily low, particularly over the last 10 years. But the 8.44% real return after credit losses, extremely attractive. Also wanted to talk about valuation as measured by unrealized gains and losses and realized losses. Okay, the green bars represent markups or markdowns in direct loans over this 20-year period. And the red bar represents trailing 4-quarter realized losses. Importantly, markups and markdowns do happen contrary to what some people say, that these loans are not marked. They are marked and seriously marked. And if you look here, it generally ranges between minus 15% and plus 10%. My second observation is these markdowns, it's like a loan loss reserve for a bank. Generally, you start with a loss, okay? So, for example, during the great financial crisis, you had rolling 4-quarter periods where you had pretty significant markdowns in the value of loans. Those eventually reverse, and they reverse for two reasons. As they reversed in 2010, 2011, 2012, they reverse either because, oh, gee, we were wrong, those markdowns were overstated, or they're reversed because those unrealized losses become realized credit losses, as reflected in the red line. Okay, so I won't get into this really very deeply, but my general observation is that the markdowns, if you look at the pattern here, the markdowns precede actual realized losses by about a year, okay, which kind of makes sense. Second observation is the markdowns generally average twice the realized credit losses. So these markdowns by these independent valuation firms or others generally are conservative, and they're conservative by almost 2x. So I think in the recent business press discussion of, hey, valuations in private in direct lending, they're just they're blown way out of proportion. They pick two loans out of 14,000 and compare, oh, we got a difference here, and they get all riled up about that. But basically, I believe that valuations are very prudent in this asset class, and that's demonstrated in the data. And then finally, here, let me just finish up by saying, hey, if we're looking ahead at forecasting private debt fund returns, okay, and I took a 3-year horizon because, as the prior chart showed, basically unrealized markups and markdowns basically converge to zero after 3 years. But basically, I put together a pro forma as to what someone might expect today from a private debt fund. So, as an LP, what you might expect, and I do this really to show you how you can use the CDLI to make these types of forecasts. So, over the next 3 years, let's start with this a bar in the bottom right, T-bill return. So our forecast, and I'm doing a lot of averaging here, so this is kind of rough estimates. But basically, the next 3 years, even though T-bills are 5.5%, I think we'd expect something like 4% over the next 3 years. If you look at the forward T-bill curve, rates are expected to come down 1% next year, 1% the following year, and then maybe 0.5% after that. So let's just call it 4. Be conservative. By conservative, I mean low. The net, if you look at the net spread on CDLI currently, and by net spread, it's total income minus T-bill, it's 5.5%. You'll note that in the chart earlier, it was much higher than that, but that probably reflects arbitrarily low T-bill rates, as the Fed kept interest rates low during most of the last decade. But we think reasonable given today's market. 5.5 might be a little bit conservative. Incorporate that of losses would be a deduction of 1%. Again, we're using the long-term average loss rate for the CDLI. General fees and expenses, 1.5%. If you look at our fee study, fees on unlevered assets range between 1 and 1.5%. I think add in the expenses, 1.5 is a pretty good institutional number. If you look at leverage, I'd like to focus on this. The average private fund has a debt to equity ratio of 1-to-1, or leverage of 1 turn of leverage. The expected return from that leverage is actually pretty modest, 2.5%. So if you go back to the unlevered amount, we had basically 9.5% minus 2.5%. What that gets us 6%. But the return on leverage is less than half of that. So everybody kind of gets excited about leverage, but basically it's expensive, and the incremental return is not as much as some people believe. So the 2.5%, basically, how do we get 2.5? We take the 5.5%. The cost of financing cost is basically SOFR or T-bill plus 2, be conservative. So basically that 5.5% becomes 3.5% spread. You have to deduct losses again of 1. So that gets you down to 2.5%. Then you deduct fees. I'm assuming here no management fee on levered assets. Some managers do. But if you just take the promote, you get something like 38 basis point at 15% promote. So if you take the 2.5 minus the 38 basis point, it's about 2%. And you think about this. So if at that 2.5%, that's like a third of the unlevered assets. And you're getting twice, you're basically doubling the risk, because if the risk level is, let's say, 4% on those unlevered assets, once you do a 1 turn of leverage, it doubles to 8, okay? But the return increases by half. So basically, when you're looking at due diligence here on fund managers, you really have to hone in on what are the economics you're getting from levered assets. They definitely help the GP, but got to focus on the LP. And then, so finally, add all this up, you get 11.13%. Very attractive return at a very attractive risk. If you look at expected returns for other asset classes, as we reported on in other webcasts, it's no wonder that roughly half the searches done in the institutional marketplace are for private debt managers. With that, I apologize for being long-winded on that, but let me turn it back to you, Fran.
Thanks, Steve. So give you a little bit of a direct lending market update and outlook for 2024. When it comes to market conditions, for the past 3 years, direct lenders really were on top of the world. We had 3 years of consecutive record inflows between 2021 and 2023, and that was met with either an abundance of deal flow or very limited competition from the public markets. So again, 2021, all-time record high for global M&A deal making. 2022, syndicated market was effectively shut due to a broad dislocation in public markets, leaving PE sponsors really with only one execution of choice to transact in, direct lending. And then in 2023, while transacting certainly became harder for borrowers due to the elevated base rate across the leveraged lending universe, volatility driven by recession fears, the failure of Silicon Valley Bank, coupled with a slow to heal BSL market, still made direct lending the execution of choice. And so in 2023, we ended on a high note, with direct lenders and their investors benefiting from record high yields on first lien investing in the first half of the year, and a pretty solid back half of the year in terms of volumes. So now fast forward to 2024, volatility has subsided. Market participants are feeling much better about the macro, but now that optimism has now dialed up the competitive landscape. And so I want to cover three main themes that's driving loan markets so far in 2024. First, just like fashion trends, everything old is new again. While direct lenders touted massive market share wins in the past 2 to 3 years, the syndicated market is back, and it is looking to take some market share back. The slew of repricings that's hitting the market should not be a surprise to folks, and I'm going to show you why in a few slides. These repricings are having an effect on yields and competition in the direct lending market. Second, we all know the mantra cash is king, particularly during periods of uncertainty. It's always critical for direct lenders to stay liquid to ensure the stability of their platforms. But now, as we've entered a period of higher economic confidence, economists are removing their recession forecasts, and we still have strong inflows into the asset class, there's a surplus of cash that needs to be deployed, and it is causing increased competition in the markets and declining yields. While everyone is expecting a pickup in deal flow in the second half of the year, the big question is, will it be enough to stabilize pricing and keep credit discipline? And then lastly, I'll talk about credit health. This is one of my favorite Warren Buffett quotes, because the main goal in credit is to not lose money. And so I'm going to cover a few slides showing you the overall health of portfolios in the space and within the index. As Steve pointed out earlier, the overall loss rate in the index, it looks pretty good for 4Q23, so that's a positive. And the non-accrual and default rates within direct lending, they do continue to remain benign, and I'm going to show you those metrics. But when we do dig into the numbers and you start to go manager by manager, dispersion is becoming apparent. The loss rates are starting to show a noticeable pickup versus where we were 1 to 2 years ago when they were extremely benign. But those stats are starting to be a little bit overshadowed by a host of newer vehicles that are hitting the market with continuous inflows and super clean portfolios on some of these newer managers. So everyone looked like a winner 2 to 3 years ago, but moving forward in 2024 and beyond, you are going to see a more bifurcated manager performance, and manager selection is going to become more important. So flipping to the next slide, we can discuss the old trends that are new again. So first, the syndicated loan market, the institutional loan market, it's back. It's strong, and borrowers are capitalizing by refinancing or repricing their debt at a record clip. You can see in both of these charts the massive amount of volume taking place in the institutional loan market in just the first quarter, mostly in the form of repricings. So looking to the chart on the left, the last major repricing wave that took place was in the first quarter of 2021, coming out of COVID. Many of the same ingredients are apparent now as they were then, including coming out of a market dislocation, a seasonally slow first quarter, a supply-demand imbalance on new issue, and a deep desire by borrowers to shave down financing costs and push out maturity. There is, however, one major difference between 2021's repricing wave and the one we're seeing in 2024, that being inflation and interest rate expectations. So in 2021, the market believed inflation was coming, rates were going to move materially higher, and this resulted in a lot of investor inflows into the asset class as a duration hedge. Meanwhile, in 2024, inflows still remain strong, even though people believe we're going to see rate cuts at some point over the intermediate term. And what you'll notice in the chart on the right is that while loan issuance has skyrocketed in the liquid loan market, the new money share in that teal blue line, basically M&A volume, is still at a low point at less than 20% of volume. And so there's not a lot of opportunities for lenders in the liquid markets to put these dollars to work. They're simply just seeing borrowers cut their costs on existing deals. So flipping to the next slide, I'm going to show you why repricing waves are predictable, because they happen in very similar patterns. Obviously, it starts with the supply-demand imbalance, basically too much cash, not enough new money volume. First quarters tend to be seasonally slow quarters for M&A and are most often the common quarter that you see repricing waves. Plus, a wide bid-ask disconnect on valuation is preventing M&A from coming together. Couple that with positive inflows into the asset class, which you can see in the chart on the left. Not only has new CLO issuance been strong in the first quarter of 2024, but CLO AAA liability financing costs are coming down very fast, which means borrowers' interest costs can come down with it. We also have inflows again into loan mutual funds. They've turned positive in that gray bar. after being negative for most of 2022 and 2023. So all these inflows, coupled with a lack of new money activity, is forcing folks to go into the secondary market, and it's driving bids up. So you can see in the chart on the right that the share of loans that are now trading above par is at over 25%, both in January and again in March. So now flipping to the next slide, we can talk about how this trend is translating into the direct lending market. For investment banks, pitching repricings is an offensive play. It's a way for them to be relevant with a borrower, earn fees. It doesn't hurt them from a portfolio standpoint because they don't hold the paper. Meanwhile, for direct lenders, repricings are a defensive play, as they don't want to lose the asset, neither to our competitors or to the institutional loan market. So we're seeing direct lenders capitulate to this repricing theme for their best borrowers, those issuers who have outperformed from a financial standpoint and have deleveraged materially versus their closing leverage, or those borrowers with spreads that were elevated relative to current market conditions, or larger borrowers that can very easily tap the public markets and get a rating and go the institutional route. These are all prime candidates for repricing within a direct lending portfolio. And direct lenders want to keep those high performing assets in their portfolio. So looking to the chart on the left, we can see that fundraising remains very strong in 2024 in direct lending. Yet when we look at the chart on the right, this shows you volume across direct lending. New money issuance simply has not kept pace. And we could take notice of the pickup in refinancing volume in that dark blue bar. That trend was notably absent from the stats in 2022 through 2023. Also notable, given sponsors are struggling to sell at the valuation multiples they desire, there has starting to been a pickup in div recaps flowing through lenders' pipelines. You don't necessarily see it in the volume numbers yet, but it will continue to be a theme this year as sponsors are yearning to return capital to their investors. Flipping to the next slide, we can see how all of this is impacting the new issue yield environment. So both in the public liquid loan markets and in the direct lending markets, spreads have been tightening over the past 4 quarters. Direct lending, first lien and unitranche spreads, they peaked in the first quarter of 23 at a historical high, and they've since tightened nearly 100 basis points through the first quarter of 2024. We're seeing fees come in, upfront fees, that's driving yields on first lien and unitranche loans down to the 11 to 11.5% area, back from 12.5% over a year ago. However, it's very important to note that the yield and spread premium that direct lending enjoys over the public loan markets, it's still there. We're still getting 150 to 200 basis points premium, and you can see this in the chart on the right. Turning to the next slide, tightening yields isn't all bad because private credit managers are benefiting on the financing side of the equation. So last year, the public bond market was prohibitively expensive and was experiencing very weak investor demand through most of the year due to risk aversion and economic uncertainty, causing many investors to slow down adding bond exposures from BDCs and the financial sector to their portfolios. But in the market opening up in 2024, investors are feeling much more confident that direct lenders are not going to cycle like people originally were projecting 2 years ago. Now these investors want to capitalize on putting money to work at really attractive rates relative to historical standards. So many BDCs and asset managers, private credit managers have taken advantage of this demand. They're rushing to the market to both refinance upcoming maturities and issue new debt to maintain their leverage profile and take advantage of declining spreads over treasuries. So the chart on the left highlights that investment grade bond issuance for BDCs in just the first quarter of 2024 has already surpassed full year 2023 issuance figures. And you could see the chart on the right, how fast financing costs are coming down as spreads over treasuries are coming back down. And while we're not yet at the tights that we saw in 2021, financing costs are now nearly 100 basis points tighter versus where we were 12 months ago. So that's a positive. Turning to the next slide, let's go and talk a little bit about credit health. So the chart on the left highlights for you the dollar amount of BDC holdings added to the non-accrual stats, coupled with the trailing 4-quarter default rate in this blue teal line. Through 2023 year end, the default rate remains benign at only 1.5%. Okay, so we're maintaining a theme of very strong credit health that we've seen over the past 3 years. In addition, direct lenders are continuing to outperform from a credit health perspective relative to the leveraged loan and high yield bond market. So looking to the chart on the right, the leveraged loan default rate ended 23 at over 3%. It's about double what direct lending is dealing with. And it's projected to nearly touch 4% in 2024. These stats come from Fitch. They're projecting 2024 is going to be a very rough year for the high yield bond market. They're projecting over 5% defaults. Interestingly, it does appear that most leverage finance research analysts are projecting defaults are going to start to moderate in 2025, most likely driven by a fall in the base rates. But to highlight what we're seeing trends in the default environment for direct lending, the common themes where we are seeing some issues continue to be venture lending, healthcare, some modest idiosyncratic issues in industrial companies, and more cyclical or discretionary spending sensitive type sectors. Flipping to the next slide, the trend of borrowers requesting to move a portion of their loan to PIK or payment in kind, it does continue to build very slowly within direct lending. So with base rates elevated for a full 4 to 5 quarters, and interest coverage ratios on new deals have come down to that 1.5 to 1.75 times area, it does certainly leave less cushion for error. For borrowers with solid revenue and EBITDA growth, they have been able to withstand these elevated base rates and 11.5% yields. But for those borrowers showing revenue softness or EBITDA degradation, it is a challenge for them to maintain their liquidity profile. And so we do see the level of PIK requests growing slowly each quarter, as evidenced by this chart. Meanwhile, the chart on the right highlights for you direct lenders within the CDLI index and how they classify their risk ratings. So the watch list, which encompasses both level 3 underperforming names, level 4 names, which are at the high risk of loss, it continues to remain pretty steady relative to the last quarter at around 10% of portfolios within the index at fair value. The risk rating 4 is akin to like a non-accrual rate. And that's where we think there's a high risk of loss. And you can see it still continues to remain pretty low. Again, the important item to note here is that we are seeing some lenders show a migration to more names on the watch list. But for the industry as a whole, the degradation has been pretty mild. And it's far less concerning than what folks had imagined 1 to 2 years ago. And then flipping to the last slide, Steve highlighted earlier how benign the loss rates were as we closed out the 2023 year. And 4Q23 did look pretty solid. However, newer managers coming on stream who are raising a lot of money with very clean portfolios, they are muting some of the loss rates relative to some of the more seasoned portfolios. So what we did here is we looked at managers that had portfolios both in 2021 and in 2023, and we looked at their trailing 12-month realized loss rate. And you can see that that theme of dispersion in performance is becoming more apparent. So if we look at the 2021 line in green, you can see that there was a very thin standard deviation of outcomes, and most managers were hovering around that 0% loss rate. But then you look at 2023, and you can start to see that there is a bigger dispersion of assets and realized loss outcomes. So again, in times like these where base rates are high, top line growth is slowing, picking high quality managers who can build diversified and high quality portfolios is becoming apparent in the loss metrics, because there is still a large amount of managers that are still performing really well and are near that 0% loss rate. So manager selection, very, very important. And those that are reaching for yield, those that are doing tougher deals, those that have more concentrated and subscale portfolios could potentially see higher losses. That concludes our prepared remarks. We hope you found some of the insight helpful, and I'm going to turn the presentation back to Steve to sign off.
Thank you very much for joining us today. I hope you join us again in 2 months when we'll be able to report on Q1 performance. If you have any questions, please reach out to us. We're always available to you. Thank you.